Without further delay, please welcome Mr. John Kosar.
Thanks, Audrey, and good morning, everyone. I hope everyone isn't too shell-shocked after the wild week that we had. Hopefully, we'll be able to, if not calm your nerves, at least give you a better understanding of what's going on in the markets. It's pretty unique. I mean, I've been doing this for a long time, and this past couple of weeks has been really interesting. So this is a monthly event. It's part of your individual investor subscription. If you're a relatively new premium research subscriber with us, or even if you're not new and you need additional help with understanding our research, and most important, how to implement it in your own portfolio, you can schedule a 30-minute Zoom meeting with us via the link right here. At the top of the research center. Here, let's get over to the research center so I can show you. So here's the link. It's right up at the top. If you have any questions about any aspects of our research models, model portfolios, click here to select a convenient date and time. It'll drop a calendar down that looks out 3 weeks. We block out hours every week. So there's typically more than enough open slots. So if you're having trouble understanding what we're doing, if you're new, I'm looking at a couple of names here that I won't mention, but I know you're new and you haven't scheduled a Zoom meeting with us. You should do that so we can teach you. I see a smile there, so he knows who I'm talking to. Do that. Do that, John. We'll spend some time and get you acclimated. This is not your typical um, chart service, or technical analysis service. I've been this is my 43rd year, and 20 years ago I was looking at stochastics and RSIs and moving averages just like everybody else. I'd like to think that we've evolved, and we've built our own indicators. My son is my business partner, and he he's got his master's of finance, from Illinois Tech here in Illinois on the south side of Chicago. And we've back tested everything that I've learned over 43 years. We've built models. We've made some adjustments to the Asbury 6, which I'm going to get to in a little bit. But yeah, if you're, some people have problems implementing this research. So let us help you. So the first thing I like to do is just kind of run through the models so we know where all the models are. So let's begin with the Asbury 6 right here. So there's a lot of crazy stuff that's going on. There's a lot of uncertainty. This is not a political statement, but just a statement of fact. We're at war with this one, we're at war with that one. The tariffs are on, the tariffs are off. We're trading with this one, we're not trading with that one. It's caused a lot of angst in the markets, and it's caused since October the 29th, the market's been going sideways. And with our risk on and risk off models, in particular the Asbury 6, when the range contracts, the model gets more sensitive because there's a smaller range, and it's trying to determine basically where we are within the trading range. So we've made some changes to the Asbury 6. We basically spent most of the past 2 weeks refining, back testing, and making the Asbury 6 more able to be able to handle periods like this. This is very atypical. This does not happen very often. So what we've done is, actually, let me jump over there really quick. I think it's important everybody knows what we've done here. If you haven't read this, read it. Special report, refinements to the Asbury 6. So basically, just like I said here, uncertainty about, Federal Reserve policy. Um, you know, Even going as far as are we going to have an independent Fed in 6 months? Geopolitical tensions obviously pushing higher. Major sector rotations that are going on. We'll talk about the CEF model in a little bit, which has really kind of been a star so far this year. I think we've outperformed by 10% so far in a really wild um, period. For sector rotation, volatility has gone up, the VIX is higher. So we did not change any of the six constituents that comprise the Asbury six. We adjusted how we use them. The A6 now dynamically adjusts for changes in volatility and trend. So it's much more sophisticated, really. It's looking not only at what these indicators are doing, but we're adjusting how we use them depending on volatility and trend. Are we in a trend? Are we in a sideways move? Here's basically what it's done. It's reduced the average number of round turns per year by 19%. We went from 10 and a half round turns is positive to negative. That's a round turn. We went from 10 and a half to 8 and a half. So it's a little less jumpy. We reduced the maximum drawdown by 15%. It was 13.6% was the maximum drawdown looking all the way back to the fourth quarter of 2017. We knocked that down to 11.5. That's a minuscule drawdown if you consider how much volatility that we've seen. When you're making models, when you get something, you have to give something. It's not like, okay, we could win all the time. And that's not how the markets work. So what we've done is we've reduced the annual return by 9%, but we've only gone from 11.6% to 10.5. So to me, that's given away very, very little for a model that's going to be a lot more robust during extreme conditions. So let's go back. So effective today, we have implemented this new Asbury 6. And it is negative. It is negative across the board. You can see all of these are the different dates. It would take 4 or more of these to turn back to positive. And we also adjusted. Now you can see we still have some trades here. I think we were 2.5 since the beginning of the year, 2.5 round turns, that is. But I want to let you know that we're aware that these extreme conditions in the market have made this model pretty ineffective, frankly, since January. So we fixed it. It's going to be a lot better. It's meant to be an indicator rather than a model. Daily indication of the broad market's internal strength. It's updated about 2 hours, typically after the close every day. Some days the data doesn't come in on time, so we do it in the morning the following day. But generally speaking, a couple of 2-3 hours after the close, and we have an update. It's based on closing values. Excuse me. We mentioned that it's negative, and again, 8.5 round turns per year versus 5 for for CPM. So let's go to CPM next. CPM is the correction protection model. This is our oldest model. We built the first version of this, I don't know, 15 years ago, probably, when Jack was still in school. It has been risk off as of March the 3rd. That's what the chart looks like going back to Q4 of 2023. Basically what it does is it sticks like glue to the S&P 500, but with about 40% less risk. Maximum drawdown in the S&P 500 has been 34% during that period. It's been 20% for CPM. Standard deviation is smaller, is lower. Beta is lower. And if you don't know, if I'm talking about terms, like you might hear me mention the Sharpe ratio. The Sharpe ratio, Sharpe with an E at the end, It is a risk-adjusted mathematical representation of how much performance you're getting for how much risk you're putting up. Investopedia.com, which I have zero affiliation with, they have a glossary, and I use it all the time. I usually link to it in the reports that we put out. So if you ever come across a term that you don't know what it is, go to investopedia.com, look for their glossary there, and it's great. They have videos, they have charts, and it's a great, for someone who's using a service like this, it's just a great kind of, desk companion. So you don't read something and not understand exactly what it means. Year to date, um, through Friday, CPM is outperforming the S&P by 1.2%. It's meant to replace the 60/40 static portfolio. If you've ever used an advisor, they're kind of all the same. They will give you some variation of a 60/40, and it'll be a static portfolio. It might 60/40 means 60 stocks and 40 bonds. It might be um, there might be a little bit of whatever the flavor of the week is. For the past year almost now, um, international has done well. International got creamed last week. We're going to look at that, but it might have a little gold. It might have a little bit of international. But this was meant to um, be an alternative to that 60/40 portfolio because 60/40 portfolios don't work all the time. Sometimes the market goes down and the bonds go down at the same time, which happened last week, which makes those pretty useless. Just to give you some perspective here, let's move over to fumble around for this chart. This is the one that I want. So AOR is the purple line down here. That is an ETF that is the equivalent of a 60/40 portfolio. Performance going back to the middle of 2018. Um,
John,
S&P.
sorry, John, did you change your share?
Oh, I did not. I did not. Thanks for catching me. I'm not nearly as good at Zoom as I am at markets. You probably find that out pretty quick. Um, so here we go. This is what I wanted to show. This is just a line chart. AOR, again, is a ETF that emulates 60/40 stock bond portfolio performance going back to the middle of 2018, right here at the beginning. Uh, the blue line up above it is the S&P 500. This orange line is CPM. And again, like I said earlier, it stays right on top of the S&P 500 over time, but with a lot less risk. Most older people, and I'm an older people, and I'm looking around at faces here, and a lot of you guys look like you're more close to me. What I've heard from a lot of people is I'd be fine with buying the S&P 500 if it wasn't so risky. I want to sleep at night. That's what we built this for. It gives you the S&P with less risk. And then up here's the CEF model, which we'll talk about in a little bit. But the CEF model, it's it's pretty close to the risk of the S&P 500, maybe a little bit less, but it outperforms over time. And we'll look at that in just a second. So the other thing, since I'm in the neighborhood here, the other thing I wanted to, you'll always hear me talk about drawdowns. Um, Here's why. The math behind a drawdown. If you have a 20% drawdown here, right here, you got to make 25% the other way in order to get that back. That's just the way the math works. Here's one that's a little bit more familiar to everybody. During COVID, between February and April, the S&P 500 drew down 34%. So here's a 30% drawdown. You have to make 43% the other way. So that's why I always harp on drawdowns. Plus, if you're an older investor, time becomes a part of the game. It's like football in the fourth quarter, I think is a really good metaphor for that. You could throw the ball up in the air, you can take some chances in the first half, once you're in the fourth quarter, and most of us, I'm sure here, are pretty close to being in the fourth quarter of our investment ball game. Got to play the game differently. You're giving the ball to your big halfback or your big fullback, and you're making sure that you don't make any bad errors, because we don't know how long we're going to be here. We don't want to work all our lives and have a nice pot of money and then take a 33% drawdown or a 34% drawdown like we had during COVID. And now I'm 72 years old and I'm wondering if I'm going to be here long enough so I can recoup that. That's the purpose of this. Here's another way to look at it. This is CPM. This is annual drawdowns versus SPY annual drawdowns. Most of the time, they're pretty close. Like in 2018, the S&P drew down 19.80, CPM drew down 15.10. But a lot of times, COVID, here's that 33.9% drawdown during COVID. The CPM drew down 9. Last year, 18.9% was the drawdown. CPM only drew down 9.3. So enough said. That's why I harp so much about drawdowns, because you don't want to make a mistake in the fourth quarter, and now you're wondering if you're ever going to see that money back in your account again. So let's shift over to SEAF. Actually, since we're here, I'm trying to avoid going back and forth between screens so I don't have to torture you, as I try to do this smoothly. SEAF right here. So this is through 3/5. This is year to date up here. So year to date, SEAF is up 9.04. The S&P is down 0.22. This is through Thursday now, not Friday. So SEAF is outperforming by 9.26. This is what I wanted to show you since inception, which is 6/25 of 2018. SEAF annualized up 20.76 versus up 12.72 for SPY, which is the ETF, of course, for the S&P, outperforming right now by 8% annualized, with similar drawdown numbers. Standard deviation 16.7 for SEAF versus 16.6 for the S&P. Beta 0.87 for SEAF versus 1. The beta is always 1 for the S&P because that's the benchmark. And maximum drawdown 29.4 for SEAF, 33.9, of course, for the S&P that we've been mentioning. So let's change screens. And go back to the Research Center. We're going to look at SEAF. SEAF stands for Sector ETF Asset Flows. And this CPM is a defensive model. SEAF is an offensive model. What people don't understand about SEAF, and I think it bears repeating, they think because SEAF does so good over time that it should make money every month or it should make money every quarter. It doesn't do that. The reason for that is because most years you don't have, here's another metaphor. Think of the SEAF model as an 11 horse field in a horse race. And once around the track is 1 year. In a normal year, those 11 horses, those 11 sectors stay in a pack pretty much. And they go around the track together. And one may win by a length and one may win by a nose. I don't know the horse terms, but you get my drift. On the years where there's a breakaway horse, we have a couple breakaway horses this year so far. I mean, it's early in the year, but we've had XLE Energy and XLI. The model jumped on those early and it stayed with them for pretty much the whole way, which is why we're outperforming the S&P by 9% in a year that if you look at the S&P 500 chart, you'd say, how the hell can I make 9% in this kind of market? It's going sideways, but that's how this works. Right now, the top three. Well, Jack and I tortured this thing and back tested it umpteen different ways. And what we found that works the best, by working the best, I mean it provides the best performance with the lowest drawdown, is by always trading the top three. So we also manage money. Um, and this is how we manage money. And this is how we recommend our premium subscribers, you all, how to use this if you want to follow the model precisely. The model is rebalanced once a week on Saturday morning. So we get up extra early on the Saturday mornings. We do the teach in so we can get all this stuff updated for you. So last week, the three CEF, top three in CEF were XLU, XLI, and XLB, which is materials. Now you can see this week, materials dropped to number 4, and XLE had moved back to number 1. So how do you trade this? Let's say last week you were in CEF, and I'm sure a lot of you were, and you were in XLU, XLI, and XLB. On Monday morning, and we use the open. So all this is done on the opening. So you get the opening range, and you can control your fill that you're going to get from the exchange a little bit better, from your broker, from your online broker. So on the opening on Monday, we're going to have a resting order sell out all of our materials at the market. And as soon as the trade comes through, we're going to allocate that back into energy. You could usually do that within the first 5 minutes of trading, and you're going to get the opening range for your sale for materials, and you'll get somewhere close to that on your buy of energy. The way we back tested this was with a hypothetical $100,000 account, and it's equally distributed. Excuse me, $33.3 thousand in each of those. So they're always equally allocated. Now, for our managed account customers, it's rebalanced every week. So let's say last week we made a ton of money in industrials, and it's now 37% of the portfolio. We adjust that back to 33.3%. It's splitting hairs. I don't think that's going to radically change the performance you get versus the performance we get. But if those numbers get too much out of line, every once in a while, you should have some thresholds and rebalance. So is there any questions about how to use CEF from anybody?
Nothing in the chat. I do have a couple of questions, but not about CEF. Do you want to take them?
Yeah.
Okay, so the first one is, do the changes in the AR6 change the reporting frequency?
The reporting frequency?
Mm-hmm.
No, nothing changed there. In fact, it's the same 6. We didn't change the constituent metrics. All we did was we added in a module that changes how sensitive the metric is based on trend and volatility. I know I'm sounding a little mysterious, and it's secret sauce, so to speak, for us, but nothing changes. It's going to look identical to you. The only thing is there's going to be a little less activity, a little lower drawdowns, which for me, that's what the A6 is for. Every day after the market closes, you could say, I wonder what the internals of the market look like. That's what that tells you. And I think it has more of a defensive. Most users are using it as a defensive tool to let us know when we should start to pay attention a little bit more. If the market's up every day, everybody's happy, right? When the market starts going down, that's when you start to look at your account a little bit more, maybe listen to the news a little bit more. So nothing changes. Was there another question?
Yes, one more question. Do these changes to the A6 filter down into how CPM operates? Will CPM trigger less often as well?
No, CPM's doing just fine. We're thrilled with CPM. CPM is outperforming during a meat grinder of a market that we've had since right after Halloween last year. CEF is SEEP's doing exactly what we want. It's giving you the S&P 500 over an 8-year period with 40% less risk. That's very hard to do. Okay, so if there's no more questions, um,
I have one more quick one.
okay.
How do you use A6 directly? This
How do I
comes
use
from
A6? How?
Yeah, how do you use A6 directly? This comes from Nancy and Warren.
Um, Directly, I use it as an indicator. I use it because you can't look at the S&P 500 anymore and volume and have any clue of what's going on inside the market because it's up 100 in the morning and it's down 100 in the afternoon. And then there's a tweet and then it goes up 100 again. And then we start a war with somebody and it goes down 100. There's no way for me that's been doing this. Maybe somebody out there you can do it, but I sure can't. So I want to see what's going on under the hood of the market. So think of a six-cylinder car. I want to see how many of those cylinders are operating. Um, do Is it actionable for me? No, I don't. Every once in a blue moon, I'll make a trade for myself because the A6 flips. But generally speaking, for your purposes, it's meant to give you a much better under the hood understanding of what's going on in the market from six different metrics, and that's what it's for.
Thank you.
Okay, so next, let's get back uh, and talk about how are we doing on time. Let's talk about carp. I had some questions during the week about carp. Carp is really for me. Now, I've got customers that we have subscribers or users who use carp to determine what parts of the market they're invested in um, when CPM is risk on. But what carp was meant, and again, a lot of these tools were tools that I built for me that I refined so they made sense for everybody to be able to use. So CARP stands for cross asset. The CA in CARP is cross asset. So you've got 9 different relative performance comparisons here. Stocks versus bonds. High beta stocks or low volatility stocks. Large cap stocks, which are usually defensive, or small cap stocks, which are usually offensive. The broad market or blue chips. When the market's strong, the broad market usually outperforms the blue chips. Um, the broad market versus tech. When the market is strong, technology usually outperforms the broad market, which is the NASDAQ 100 here versus the S&P 500. Growth or value. Growth is offensive, value is defensive. US or developed. Which parts of the world? If we're strong, we're outperforming developed markets and we're outperforming the emerging markets. There's no absolutes in these things, but generally speaking. So this lets me know. So now I look at this and I say bonds are outperforming stocks. The price of bonds, not yields. That's negative. Low volatility stocks are outperforming high beta. And these are 3 different time frames. This is weekly, monthly, and quarterly. Um, you can see the broad market is outperforming tech, defensive, value outperforming growth, defensive. Both developed and emerging markets are outperforming us. Atypical, but generally defensive. So now I know sometimes, even though the S&P is going sideways, and I don't know if it's going to break out to the top side or if it's going to break out to the downside, I know underneath the hood again, I know I use the same metaphors for everything, but inside the market, it's set up defensively. Most money managers cannot go 100% to cash. Most of the RIAs that we work with and that we know, they can go to 20% cash, but 80% of that money's got to be in the market. People give them their money so they can invest it and not sit on a pile of cash. So you can tell by looking at this metric, those people that have to be in the market and don't say, oh, well, the heck with it. I'm not going to trade until this thing shows me a trend. Um, these people are set up defensively. And then we do the same thing with three different fixed income relative comparisons, either government or the corporates, high yield or corporates, or short term or long term bonds. So that's what CARP is for. Some people, when we were risk on last year, for most of the year, basically from April till October of last year, we were in the market. We were risk on. CPM was risk on, I should say. Some people came here and they said, well, tech is outperforming the broad market, growth is outperforming value, and high beta stocks are outperforming the low volatility stocks. So I'm going to buy some of these ETFs and put them in my portfolio. So instead of just getting the plain vanilla S&P 500, now I've got high beta, now I've got value, and now I've got tech. And if you look at charts of all these, and these are the symbols right here, if you can see my mouse moving, those are the symbols. You look at those symbols and see what they did versus the S&P from April to October of last year. They all outperformed by various degrees. So it's a way of when CPM is risk on, the market's cruising along, you could amp up your performance a little bit by understanding what's outperforming what. Um, okay.
So, John,
Oh,
while you're on that topic, what is the green versus the white on carp?
good question. And I'm going right back there because I also want to talk about US versus the world. Green and bold means that there's a trend in two time periods: tactical, which is right here, and strategic, which is right here. Tactical is a business month; it's 21 days, business days. Strategic is a business quarter, which is 63 business days. So when we have um, the same ETF that's outperforming in both tactical and strategic, it gets bolded and it gets a green shade to it. So those kind of pop on the um, graphic. So bonds outperforming stocks in both the tactical and the strategic. Same with low vol. Same with broad market. Same with value. Now you could see here that on a strategic basis, blue chips, which is the Dow 30, is still outperforming broad market, which is the S&P 500, but it's not doing it in the tactical. I want to find both of these time frames moving in the same direction rather than being scattered, um, like some of these are. So that's why. Um, a very similar model, but now we're looking at global equity indexes is US versus the world. Interesting to watch this every week. What happened back in August, Peru started outperforming on both a tactical and a strategic basis. And then it was Brazil, and then it was Chile. I may have the order a little bit messed up, but you can see here's Peru started on 8/5, August 5th of last year, is when it started outperforming on a strategic basis right here. Then after that, and it's not, we didn't arrange the table this way. It turned out this way. The next thing to turn was Canada and Mexico, right around the first half of November, as you can see right here. Then after that, you started, um, Switzerland started on Nova, Nova the 11th, Spain on November 5th. Then we bled into October for Western Europe. Then when we got into December, you started to see outperformance start to. So, this was in layers. It wasn't like one week everything outperformed us. This was kind of following a step at a time. And then you had Asia Pacific here. Um, Now, these have since fallen out. For a short time. We had outperformance in both the UAE and Saudi Arabia, Kingdom of Saudi Arabia, KSA, they are no longer outperforming. And then the last one to finally kind of drop into place was Oceania, which is Australia and New Zealand and a couple of other islands out that way in that particular region. But that's how this works. If the market's falling and we go into a downtrend for a while, which we're up as much as 45% since April of last year, it would be more abnormal to not have a correction. But I can't see the future. It took me 20 years to figure out that forecasting is a euphemism for guessing. I don't do that anymore. I use data. I follow the data. I'm not smart enough to figure out what's going to happen next week. And the good news is pretty much everyone else can't do it either. So we follow the data. But if we go into a downtrend, you may come to this table and say, which one of these countries might I want to take some of the money that I had allocated here and put it somewhere else? You need to look at relative performance charts to do a good job of that. But this is a great screening mechanism to help you understand globally what's outperforming us. Uh, Everyone now says, well, you should have some international in your portfolio, but that is it's kind of a fallacy, and I'll show you why. All right, so you should see a chart now of Apple. That's not what we're going to look at this moment. SPDW is the Spider S&P World um, Developed Markets Index ex-US. Oh, everything's in here except us. Um, if you look at this, now this is SPDW versus us versus the S&P 500. So if you look at this, you'll say, well, John, since January of this year, the S&P these overseas developed markets outperformed us by almost 10% into February 27th. And then look what happened after the war started. After the war started on 3/2, I know we're not supposed to call it a war, but when the war started, look how much we gave back. We gave back some 5.5% of this. So what this means is that even though the rest of the world was kicking our butts here for 6 or 8 months, once the war started, everybody jumped out of those foreign markets and went back to the US because we're still the strongest economy. Even though we have tariffs and all this stuff going on, we're still the strongest economy. Everybody moved back to the safety of the US, which is why in from 227 through the end of last week, uh, this SPDW underperformed by 5.5%. It gave back more than half of this big gain that it made since January. Here's why I'm showing you this. Everybody's like, well, you really, I watched the Suits on CNBC, so I see what the chatter is. And you really should have international in your portfolio. This is a daily chart. And you can see this is outperformance by SPDW. This is a weekly chart going back to, let's go back to here. Let's go back here to September of 09. Since September of 09 through the end of last year, the end of 2024, you would have underperformed the S&P 500 by 71% for whatever foreign. Now, this is a broad foreign index. There may be certain indexes that did better, but this is why I'm not jumping on that. Everybody should have international in their portfolio because what's happened this year is atypical. Typically, the stock market goes up. Global stock markets typically go up. And when global stock markets are going up and things are good around the world, everybody wants to be in the US. Again, it's not a rah-rah US or anything that has to do with politics. I'm here to make money for myself and my family and to help you guys do that. So I just wanted to point that out. Um, so enough said there. Let me change screens and I'll take some questions if you got them. We're going to go take a look
Just
at
one
ETF trade.
question. Do you trade based on A6 in your managed funds?
No, CPM is in our managed funds. CPM is. A6 is too jumpy. Um, CPM is more sedate and it works better in a as part of a managed portfolio. We'll talk about that before we're done here. I just want to let you know that we do that and show you how we blend models to enhance performance. So back to Research Center and ETF trade ideas. All of our ETF, let me back up a step. These are trades. These are not investments. Um, I always like to show this. Excuse me. This is real-time performance going back. Well, this is from 3/17 of 2023 through January the 9th. We're going to update this at the end of the quarter. At the end of this month, we'll update it so we'll have a little bit more than 3 years of data. But during that time, 120 trade ideas, roughly 4 per month. We don't trade by the calendar. We don't go, well, it's Thursday, so we have to give them a trade. Some companies do that. I think that's nuts. We trade when opportunities come. Jack built a model that scans 6,600 ETFs. We do that every morning at 5 in the morning, and we scan them for particular criteria that pertain to three things: trend, relative performance versus whatever its benchmark might be. It's usually the S&P 500, and asset flows, AUM. AUM in ETFs is shares outstanding multiplied by NAV, and that gives you a dollar amount of how much money is in that ETF, is invested in that ETF. Then I look at them subjectively and try to find those that have the best risk reward, which I learned mostly from spending 17 years on the floor of the Chicago Mercantile Exchange when I was young. Anyway, um, maximum drawdown, only 3.7%, minuscule. Percentage of winning trades, 54% of these trades are winners. But here's the important number. Average winning trade is 5.5%. We're in that trade for about 20 days on average. So on the winners, we make an average of 5.5%. We're in the trade for 1 day short of a business month. Average losing trade is less than half of that. It's 2.4%, and we're in those 8 trading days or about a week and a half on the calendar. This is why we do this, and we turn this over and we turn this over. So more winners than losers. Winners are larger than losers. The Sharpe ratio of 1.4 is exceptionally high to be held for 3 years. Our models, some of our models, or some of our model portfolios have Sharpe ratios that are 1.04, 9.9, or 0.97. Trying to find any strategy that can maintain a 1% Sharpe ratio over the course of 8 years that isn't some crazy obscure triple leveraged crude oil thing that had a really good year 4 years ago is really hard. I've spent a lot of time trying to see, is anyone else getting this kind of performance? I haven't seen it. It's probably out there, but I haven't seen it. So anyway, that's how this works. And right now, we're out of everything. Um, Everything turned really hard after starting last Monday, which was after we attacked Iran. So 7% outright loss here in steel. Lost 6 against the S&P, XPH. All these were winners up until the beginning of last week, and they dropped so hard. -4. We only lost 1 versus the S&P. EEM, emerging markets, we lost 4 outright, but we outperformed the S&P by 1. And XES, we took a 19% profit and we beat the S&P by 22%. We put this trade on January the 14th. So if there's a new trade in here, these are going to be moved down here to the closed ideas later on in the weekend. Any new ideas will show up here. If there's a new idea, you're going to get an Asbury alert and it will show you a chart, show you what we're doing, and it'll show up here and there'll be a yellow highlight here to let you know that it's new for that particular week. If there's a change in the valid above, which is a soft stop, this is basically valid above means valid above this price. It's not a hard stop, it's a soft stop. If we're stopped out of something, you're going to find out because you're going to go to the research center. And let's say next Tuesday, we had a trade on and we got out of that idea. So what you'll see here is March 10th. It'll show you that this date has changed. That means something changed inside the table. You click there, you go to the table, and whatever we did, whether it was move a soft stop or put on a new idea or got stopped out of an idea, it will be highlighted in yellow so you understand what we did. Finally, the markets monitor. Markets monitor is updated once a week on the weekend. It's meant to be a tool that you use on the weekend or early the next week to be able to say, well, I don't have time to go through all of those various reports. I just want to know what changed or where we are. When to be invested, you got Asbury 6 and correction protection model. Where to be invested, CARP model, which we looked at. We have a CEF model for sector rotation. We also have a CEF Ultra, which is actually killing it so far this year because CEF has done so well. I don't talk about it because it involves some leverage, but I can help you with that if that's what you want. ETF trade ideas, and here's international. If A6 changes from Tuesday to Wednesday, it's not going to be here. It's going to be updated on the weekend. We have a special rectangle, a special box for A6 right here. So I'm not going to be wasting my time where I could be looking at markets and helping you make money so I can keep this thing up every second of every day. So just for the weekend. So if the A6 switches over here on Wednesday and you don't see it here, that means it's not the weekend yet, and it'll get updated on the weekend. So that's Markets Monitor. What I'd say is don't necessarily try to use all the ideas at the same time. To me, think of it as like a buffet. When you go to the buffet, you don't eat everything that's on the buffet table. You put a few things on your plate that you like, and you go sit down. Same here. Trying to do all of these at once, and then you've got to figure out how do I make a portfolio out of these things? How much CPM should I use? How much CEF should I use? It's a whole other skill set. Some people can do it. I think most of the people that sign on with us, we have people that have been with us for 20 some years. They are do-it-yourselfers. They are market heads. Oftentimes, they're older guys or gals, who retire or just love the markets. So they watch CNBC all day or they watch Bloomberg all day, and they like tinkering with this and building a model portfolio and adding a little bit more CPM this year or a little bit more CEF or maybe using this a small amount with the CEF Ultra. They like doing that. Other people look at all this and they go, I can't do it. It's too much. I'm busy. I got grandkids. I play golf. I'm still working. If that's the case, that's when Jack and I decided that we were going to start to manage money. Um, and so we built four model portfolios. We began offering managed accounts to both individuals, and we also managed money for some other RIAs. We started in mid 2024, very, very small. We've been growing very quickly. Again, we're small shop. It's Jack and I for the ideas, and we have partners that do the execution and the compliance and the website and a long list of people that are involved with this. But we focus on building models because it's fun and we like it, and I'm going to do it as long as I can sit in this chair. Um, but um, we're up to from zero in a year and a half, and most of this has been over the past 6 months. The vast majority of it, we're close to 70 million under management, and we're growing. So we're really happy about that. Um, so we created four model portfolios with different risk reward characteristics. We use our own models as building blocks. So it's going to have, they all have a little bit of CEIF, they all have a little bit of CPM, different amounts, and we've back tested them. And what we found out is that by blending the models, we get some style diversification, which actually tamps down the drawdowns even further. It tamps the risk down even further. Um, we began offering them to investors in 2025 is really when we started. We had a few small accounts in 2024. A lot of it was our own money. So really in 2025. So let me go back here and just kind of show you how we're doing here. So this is since inception. We have Asbury Aggressive, Asbury Balance, Asbury Conservative, Asbury Ultra Conservative. Asbury Aggressive this is since inception. It's outperforming the S&P by 5.12%, with a, a lower standard deviation, higher Sharpe ratios, lower beta. Our Asbury Balanced is up 3.17 since inception. Our Asbury Conservative, trailing by a little less than 1%, but the drawdown is minuscule. The risk on this is very, very low. If you want the details on all that stuff, contact me privately, and we have a fact sheet for all four of these. And we'll send them to you, and we can discuss them with you. The ultra conservative is chasing the S&P by let's call it by 4.5%, since inception. But the maximum drawdown, I think that it had was like 6%, minuscule, tiny little drawdown for all this volatility. That's meant for people that the S&P is too scary for them, and they're not getting enough of a yield on a T-bill, which a 3-month T-bill is about 3.7% right now. But anyway, and here's how we're doing year to date. Asbury Aggressive up 2.61, Balanced up 3.71, Conservative is up now 1.82 year to date, and Ultra Conservative, again with the minuscule drawdown, is beating the S&P by 2.5. So that's enough said there. I just wanted to spend a minute because the people we lose as subscribers, almost to a man or to a woman, are people that say, I love your approach. I don't have the time. I'm too busy. I don't understand it. I'm not getting the same performance. I had one guy tell me that he wasn't getting the same performance as us, and he was trading the CEIF model. And I said, are you following all the signals? He goes, no, only the ones I like. So, some people don't have the discipline for that. It's very, very difficult. I didn't have the discipline, which is why I'm doing mathematically driven models for my own money, because I continually thought I was smarter than the market, no matter how many times it slapped me down. Now I just follow the models. So The next thing we're going to do is we're going to go through keys. There's a lot of really important charts I want you to see. And while I'm fumbling around to get there, I'll take a question or two, if there are
Perfect.
any.
Yep. So in managed accounts, can you go all cash when CPM says get out?
Good question. The way we trade these, when CPM goes risk off, we go from being in SPY to being in BIL, BIL. And BIL is it's an ETF that emulates the yield on a 1 to 3 month treasury bill. SEAF stays in the market regardless. Um, SEAF's always in the market. SEAF's best year was when the S&P was down in 2022. The S&P was down 19.6%. SEAF was up 8.4. So we outperformed by 30% that year because I don't know if you recall that year, but the first half of the year, energy, XLE just took off like a shot, and that was one of our top three from January through June. So that's how that works, and they're kind of working on two different speeds. CPM is trying to protect your downside. When the market looks scary, it goes to cash, it goes to bill. But the CEF model is a part of your portfolio that always stays there, and it catches any opportunities that may occur while the broad market is getting beaten up. There might be one or two sectors in there that if you can catch them and find them fast enough, that you could be making money while everyone else is losing money. So I hope that answered that. Are there any more?
Yes, I have a couple more.
Okay.
Next question. With the volatility due to rapid policy changes, does that significantly increase the risk of holding individual stocks versus sector ETF?
Yeah, if I understand your question, now we pick stocks. Actually, Jack's pretty good at it, and we pick stocks for um, some hedge funds. It's a separate part of our business. The reason that we don't do that for this part of our business is exactly that reason. The overnight risk on individual stocks is much jumpier when the market is indecisive of what's going to happen. The market does a really good job of handicapping, I guess is a good word, bad news. It's able to handle bad news. What the market does not handle well is um, indecision. Tariffs are on, tariffs are off. We're friends with that one. We're not friends with that one. We're bombing this country today. We took that country over last week. That stuff. And again, it's not a political thing. I have my politics, everyone else does. I don't let my politics get in the way of my money or get in the way of my clients' money. This is just inconsistency geopolitically makes these stocks jumpier. So yes, that's the short answer is yeah, it's the overnight risk is much bigger when you're dealing with one stock instead of a basket of 30 stocks that might be in an ETF.
Thank you. One more question. To what extent is the EEM world versus SPY performance due to the dollar value?
I don't know, is an honest answer. There is no direct relationship between the only direct relationship that we look at here is when the dollar starts up, a rising dollar oftentimes coincides with a weaker stock market. Not always. There's nothing in the markets that's always, but um, the trying to figure out how much has to do with the dollar. Is it 40%? Is it 20%? You don't make any more money knowing that. Um, we look at relationships, and what we've noticed relationships wise is when the dollar is outperforming the S&P is going down. And that's what's starting to happen now. So with that, excuse me, I've got some allergy issues here, so I'm not coughing in your ear. So the Keys comes out Thursday or Friday towards the end of the week. I usually like to get all the numbers and all the drama out of the way before I write Keys, and I write Keys on a Tuesday, and it's already invalid by Wednesday. I like to let a little bit more data come out. That's why we do it at the end of the week. This is the S&P. This is this sideways meat grinder that we've been in. So 6720, which is where we went on March 2nd, which was the first day that it became apparent that we were in a war. If we break 6720, there's really no support till we get down to the S&P 500 at 6583, and then here at 6522 we have this benchmark low that we made right around Thanksgiving of last year. So watch 6720. If we break it, we could see a very fast move down to these support levels. If it holds, who knows? Maybe we'll go back up to the 50-day moving average. But again, the A6 is currently red, and this is, the new A6 that is, that has a component that accounts for trend and volatility. CPM's been risk off since the 4th, I believe, early to middle part of last week. The NASDAQ Composite Index is sitting on a major support level. It's on its 200-day moving average already. Let's call it 22,000. It's the 200-day moving average, and here's that low from right before Thanksgiving. If we break this level in the comp, sirens are going to be going off in our office here. I want to know that, because that means one of these major indexes has broken a big support level. Apple, this sideways pattern, it's called a symmetrical triangle. I don't like a lot of the jargon that people use with markets, but basically it's investor indecision that has resolved itself to the downside. If we stay below 265 in Apple, it targets a move down to like 220. And Apple is highly correlated to the S&P 500 and to both of the NASDAQs because it's such a big stock according to market cap. So watch Apple under 265. It's vulnerable for a much bigger decline. Cumulative volume. When cumulative volume breaks its 21-day moving average. Why do we use a 21-day moving average for this instead of a 200-day? This is a tactical tool for us. Our tactical time frame is 21 business days or a business month. It's starting to edge below here. You could see it did that in early February and gave us this little dip here, but it came right back up, stopped the bleeding. If this stays down for an extended period underneath the 21-day moving average, we're going to get a correction. So this is something we watch all day. This is actually a part of the Asbury 6. Asset flows in the Qs. Note that between November 13th and 25th, the asset flows, the AUM in the Qs, QQQ tracks the NASDAQ 100. Note that between November 13th and 25th, it fell below, indicating money was coming out of the Qs, gave us this. Once we recovered, things were okay again. We didn't light the world on fire, but we started to tread water. Look what's happening here since Feb 3rd. For the whole month so far, it's not falling apart, but it's underneath the 21-day moving average. That's what happened in NDX. So we're watching this. As long as that AUM continues to contract, meaning people are saying, I'm taking my money out of here and going somewhere else, we're going to get more weakness in NDX. That's going to push Apple lower. And we know that Apple's in a bearish pattern, and maybe it breaks the support level that we looked at in the comp, which is up the top. This is relative performance versus SPY versus AG. AG is the aggregate bond ETF. When stocks are outperforming bonds, that's usually during a period that the market's going up. We use the 63-day moving average here because that's a strategic time period. I want to know what the quarterly trend is, and this shows me that. So note that this trend turned up on a relative basis in May of 2025. That was a few weeks after we bottomed last year on April the 7th. Tested on October the 10th, near-term bottom. Broke it for a couple of days on November 20th, but it moved back above the 63-day moving average. That gave us this bottom. Here's December 7th. Here's January 16th. This is now. It's starting to roll over. That tells me we are vulnerable. As long as SPY continues to underperform AG, we're going lower in the S&P 500. So something else we're focusing on. This is inflation. This is from the Fed's website. It's free. It's the source Federal Reserve Bank of St. Louis by a FRED. FRED is an acronym for Federal Reserve Education Department. I don't know what it is, but it's FRED. You can see the 5-year break-even inflation rate is a market-based estimate of the average inflation rate investors expect over the next 5 years. Chart 7 shows this metric has been rising. It's modestly, okay? This is only a 1-year chart since late December, when the 5-year break-even rate rises while economic growth is slowing, as it is now. It historically tends to coincide with a weaker or a declining stock market, particularly in the S&P 500. It's an unfavorable macro backdrop for equity prices. So something that we're watching closely, and the higher this goes, the more downward pressure it's likely to put on the market. It indicates that the credit spreads are showing that bond investors are starting to price in inflation 5 years out. This is size and style. We're still overweight small cap, have been since December, but you could see gave a whole lot back last week. We're testing the 63-day moving average. If it breaks the 63-day moving average, we're out of there, and we'll probably move back into large cap. But right now, this trend is still intact, but it's given about half back quickly. And again, the catalyst for all of this was the attack on Iran. That shuffled the deck. Everything moved a lot. And value. We've been overweight value since November the 13th, and we have a nice lead. Last thing I want to point out here is something that we've added. It's a little subtle addition, but what we do is we pump all these different technical and quantitative events, many that we just talked about here, and we pump them into the computer and have it tell us what kind of an environment we're in. So economically, when technology stocks are underperforming the broad market, bond prices are outperforming stocks, the energy, utilities, and industrial sectors are outperforming the S&P 500, and the 5-year break-even rate is rising, it points to a late cycle inflation pressure environment with rising economic uncertainty. This is often described as a late cycle inflationary slowdown or stagflation leading. If you watch financial news, you've been hearing the stagflation word coming up here over the past couple. So if you're saying, well, what does all this disparate stuff mean? That's what it means. Does it help you make any money? No, but people like to know that. And it's just a little wrinkle that we've added here to take all of these things that we think are important out of maybe 100 things that we look at, throw them into the computer, have it tell us what it all means. That's it. So let me look at some live charts. This is the last part here.
Yeah. So we have a question.
Okay.
How do you react to major world events like the Iran conflict?
By looking at the data. That's a really good question. I don't make emotional decisions ever. I did it on the trading floor for 17 years, and I've got the scars to prove it. Um, uh, we look at the data. I'm not interested in what I think it means. I'm one guy, I'm a reasonably smart person, but I don't use that. I don't use my 43 years experience to tell me if I should be buying or selling. We look at the data. The data tells us, the Asbury 6 tells us, the CPM tells us, the CEF model tells us where the money's going. Are people nervous? Are people buying and holding overnight, or are they selling? Which parts of the market are outperforming? Which parts of the market are underperforming? Is all the stocks participating in this move, or just a handful of them? What's volatility look like? Where's support? Where's resistance? All these different things tell us quantitatively what the market thinks of what just happened, whether it's a new tariff number or whether it's an invasion of a foreign country or trade dynamics changing around the world. What I know, or what, yeah, point. I think I made my point. I want to know what the market thinks of the events and not what I think of the events. Um, I've taken too many beatings and know that I'm not that smart, but I know how to determine what the market's thinking by knowing where to look. That's why we look at 5 year break evens. I'd probably look at 20 charts, through the Fred website every day. I want to see what's going on with a number of different things, various spreads, various economic data. Is it moving up? Is it moving down? And when we think it's important enough, it ends up in keys. And then I look at that, and that tells me what the market's thinking. And then I'm acting on a um, comprehensive look at data and not what I think it all means. So enough said there. Any more questions before I move?
We're good at this time.
Okay. So now what I do at the end is I prepare a bunch of live charts that I think are the most important to be watching right now. That's what this is. Now they're in alphabetical order. Excuse me. And we're not going to, some of these are going to be redundant to what we just looked at in the keys. This is Apple. Here's the breakdown that I had talked about. Let me move a couple things around on my screen so I can see what I'm doing here. Apple sideways, breaking down. This is Apple versus the S&P 500 down here. Look what it's doing. It's starting to spend more time underneath the 63-day moving average, which is gold, and the 21. So that means it's now underperforming the S&P on a quarterly and on a monthly basis. That's important. If this breakdown sticks, meaning we don't go back inside the pattern, we're going lower. And if Apple goes lower, the market goes lower. This is SPY Ag. You can see when ag, which is bond prices, we spoke about it earlier, are underperforming stocks. Here, let's look at it this way so it makes more sense. So we're going to look at SPY up here, and we're going to look at ag down here. So when SPY stocks started to outperform ag bonds right here on May 8th, and outside of just a couple of days, it stayed up above it on a 63-day basis, which is the gold line that gave us this big move higher in the S&P. Look what's happening now. It's starting to underperform. When SPY underperforms ag, like it, so here, SPY underperformed ag between February 21st and let's call it May 2nd, May 3rd. That gave us this big move down in the S&P 500. The longer that SPY stocks underperform ag bonds, the more likely that we're going to see something like this. That's important to know. Um, this is BNO. This is Brent Oil Fund. The reason I put this one up there is when I was with you last on February 7th. Was it Feb 7th? I think so. Um, I'm not sure. I think I talked about this chart at least for the past month and maybe going all the way back to January, talking about it was starting to break out higher. Well, look what's happened here. Just since Feb 2nd, which is right around when I was with you last, it has risen by 45%. So how high do I think it's going to go? We don't know. I'm hearing there's somebody on Bloomberg yesterday talking about crude oil going to $140 a barrel. Now, the way you get on CNBC is have a nice suit, be reasonably good looking, and say something outrageous, and you're pretty much going to get booked. But there are people out there that are looking for $120, $140 a barrel. Comp. This is a NASDAQ composite index sitting right on major support at its 200-day moving average right here in orange, and this low from November 21st. We looked at this already, but that's the live chart. If we break through here, market's in trouble. Here's, let's see what else we have here.
John, would you speak to the chart on TNX?
I'll get there. Yes, I will get there. This is 50,000 in the Dow. Tried to get above it, and now we failed. Part of the reason the market reversed, at least technically, is we're testing 7,000 in the S&P, big fat number, all-time high. 50,000 in the Dow, big fat number, all-time high. This is a big resistance level. This is MAGS. This is the Magnificent Seven. And you could see it's already starting to break its 200-day moving average here. The linear correlation between MAGS and the two NASDAQs is like 0.95 going back is from the inception of MAGS, but this is already starting to break down. This is the MAG 7. This is the seven stocks that basically drove the rally last year. This is NVIDIA. NVIDIA is sitting on its 200-day moving average. So if we can't hold in here next week, we're in for trouble. This is the OEX. The OEX, which is the S&P 100, right on its 200-day moving average and holding the support level that dates back to mid-October of last year. OEX has also been underperforming the S&P 500 since December the 10th, when typically in a bull market, the S&P 100 outperforms the 500. That's not happening now. This is dividend stocks versus growth stocks. Let me change the ticker here. Dividend stocks typically don't outperform in a healthy bull market. They've been outperforming growth stocks since January the 5th. That is negative. This is kind of when the market stopped going up, when the S&P stopped going up, you were getting all of these relationships that indicated the market was going into a defensive mode. Again, investors, professional investors have to be in the market, rain or shine. When you start seeing them moving into dividend stocks and out of growth stocks, it tells you that they're kind of going into the turtle. And that's what's been going on since the beginning of the year. This is the SOX index. The SOX index broke out here and we had targeted 8,600. Got really close to 8,600. It got to 8,498, about 100 points away. If it breaks 73.93, that means this is a top and we're going lower. And the SOX is one of the a handful of indexes that's been holding the market up. So watch the SOX, watch 73.93 in the SOX. We already looked at this. This is the world indexes versus the S&P. This is SSO. This is two times leveraged S&P 500, also testing its 200-day moving average. What else we got here? VIX. VIX has been above the 21-day moving average since, for all practical purposes, since January the 12th. S&P 500 is in the lower panel. It couldn't go any higher. Now it's starting to roll over lower. Elevated VIX means the market's afraid. When the market's afraid, the S&P goes down. Here's TNX. Was that the one that somebody asked for? Was it TNX?
Yes, it was.
TNX is the 10-year Treasury yield index. I actually pulled this one out because look what's going on. You've got a big, treasuries are very technical in nature because it's harder to push the global bond market around than it is to push the S&P 500 around for short periods of time. This trend line started in January of last year. You got a lot of touches on that trend line here. We tried to break through it back in latter part of January, and now we're right back up there again. If these yields consistently get up above, this trend line is roughly at, where are we? Let's call it a 2.9% yield. Let's just say 3%. If the yield of the 10-year gets above 3%, stays there, we could very well end right back up here, which is 480. And 480 is a big, big level here, 460, 480. So if yields don't settle down here and they continue to move higher, which means the market's getting nervous again, yields can get back up to this 5% area. If they do, might be a great place to buy CDs again. I mean, I'm a stock guy and I bought CDs up here at 5% because I actually bought them here in 2024 because I looked back on this chart and I knew that this was up at the top of the range. Historically, it was a good place to buy CDs. They get back up here again. Now we can start looking at T-bills again. Now we can start looking at the yield curve and see where on the yield curve is going to give us the most yield. But yeah, that's a good thing to talk about. So we're almost at an hour and a half. I'm going to stop my
Yeah.
share.
Another
Yeah.
question. I know you covered SOX, but where does SOX versus QQQ stand? In the past, I believe you mentioned this as a proxy for market direction.
I don't really look at stocks versus Qs. I look at everything versus the S&P and versus the S&P. All right, here's stocks. Let me just move a couple things around on my screen here so I can see what I'm doing. SOX versus the S&P is at a really important place, and I should have mentioned this earlier, so I'm glad you brought it up. The SOX started outperforming the S&P on a quarterly basis. That's the gold line here on May 12th, and it has stayed above it since then. Gave us all of this in the SOX. When the SOX goes under, starts underperforming the S&P like it did here from February 24th of 25 to early May of 25, the SOX dropped and so did the S&P 500. The SOX is testing that relative support versus the S&P at the 63-day moving average right here. If this is still a good trend, it's going to recover here from 73.93 and probably go up and hit that 86 target. If 73.93 is broken and this is broken, now we're in a more serious downdraft that could last for a while. So basically, heading into next week, if next week is gangbusters and goes higher, and those support levels hold, we could go back up and retest the highs, but everything is sitting on, not everything, a lot of important indexes and individual charts, going back to NVIDIA, going back to Apple, are sitting on really important levels. If we have a lousy week next week, we could be going into a corrective period here that could last, well, it's throwing a dart to see how long it lasts. But again, I'd have to see the CPM go back to risk on before I felt comfortable again. Any more before we call it a day?
No, we're all set.
Okay, so finally, again, if you can't figure out how to use our tools, ask us. Go to the research center, book a Zoom with us. We're going to send you a video. We're going to send you a link later this weekend. That'll have the video from today. Look for weekly wrap up on Sunday. Let us know what you'd like to see in future teach-ins. Let me know if you like this. Is this helping you? What can we do to make it better? I really enjoy doing them. It gives me a chance to talk to everybody that wants to be talked to once a month. We will see you in a month, tentatively Saturday, April the 4th. We do these on the first Saturday of the month. We'll officially announce the date and time and give you an opportunity to sign up via email that you typically get 10 days before the event. Thanks for your attention, and see you in a month.